Okay, so this is a exam chapter 22, exam 4 problem that would be a very good problem that we would see on your exam 4. This is basically an accounting error that took place. So anytime we have an accounting error, we have to make a correction. If the error occurred in the year that we had the books open, we would just simply make an adjusting entry and do that. But what would happen if we had 2 years, or say 3 years later, 4 years later, we discover the error? What do we do in a situation like that? So the problem is it's Abbott Company who purchased equipment that cost $5.5 million on January 1st, 2017. The entire cost was recorded as an expense. So we see right away they took $5.5 million and they recorded it as an expense. They shouldn't have. The equipment had a 10-year useful life with a $500,000 residual value. So they should have depreciated it. Abbott Company uses a straight line method to account for depreciation expense. The error was discovered on December 10th, 2019. So December 10th, we have 2017, 2018, and now we're into the third year, all the way almost to the end of the third year. So we have 3 years that have expired, and they discovered this error. So Abbott is subject to a 35% tax rate. So what do we do? How do we tackle this problem? Well, let's look and make sure we understand what took place. So basically what they did was they took $5.5 million and they expensed the whole thing. And they shouldn't have. Okay? So they expensed the whole thing. What should they have done? Well, they should have taken the $5.5 million, subtracted the residual value, which gives me $5 million, right? And then we divide that by 10 years, and that should give me a $500,000 depreciation expense every year for 10 years, okay? So a question might be asked, how much did they understate or overstate net income in the year 2017? Well, we know if they overstated expenses, they would have understated net income. In other words, they recorded too much expenses, and so therefore their net income was lower as a result. So we have to account for that. So if the question is how much did they understate net income, we can answer that question. Basically, what they did was they took $5.5 million, and what they should have done was only take $500,000. So that leaves me with a $5 million. That leaves me with a $5 million expenses that they shouldn't have done. So they overstated net income by $5 million. Now, we know anytime there's an accounting error, we have to do net of tax. Well, the tax rate is 35%. So net of tax would just be 1 minus the 35% rate, which is 65%. Okay? Then we would take 5 million, multiply this by 65%, and my math is correct. 5 million times 0.65 should give me a $3,250,000 understatement of net income, an overstatement of expenses, okay? So we know for 17, they really had $3.25 million in net income that should have been higher than what it actually was, okay? What if the question was, what about if we discovered the error in December 10, 2019, and the books are now open in 19 but not in 17, how do we make this correction of the error? Well, that would be what we have to look at and say, okay, what will we record at December 31st, 2019? So we basically take our depreciation, and we know that 2017, 2018, and 2019, so there's 3 years that have gone by. So we have $1.5 million, okay? So $1.5 million in depreciation expense that they should have expensed, okay? But remember, they expensed $5.5 million. So we take the $5.5 million, we subtract the $1.5 million, and then that should give me a net amount of $4 million. Okay, but remember, this is net of tax. So we multiply this by 65%, and 4 million times 65%, if my math is correct, should give me $2,600,000 that they recorded, okay, or that they understated net income by. So the way that we would correct this then is remember, we had this account called prior period adjustment, and we would debit 2.6 million, and then remember, what do we do with net income? Whenever net income, it's a credit balance, right? Sales are credit balance, expenses are debit balance. So if sales minus expenses, credits minus debits, we should, if we have a profit, we should have a credit amount left over. Well, when we close the books at end of year, we debit net income and we credit our retained earnings. So if we didn't do that for 3 years, then we would just simply debit our prior period adjustment and we would credit our retained earnings by $2,600,000. Okay, and I just ran out of space, so we'll put a K there. All right, so that would be a really good example of a problem that you would see on exam 4, and a really good problem relating to correcting accounting errors.